Good afternoon, ladies and gentlemen. Thanks very much, Taxsutra, for giving us the opportunity to come and speak on this very important topic. This is post-lunch, and we do have, I would say, very unenviable task of keeping everyone awake. So let's try to make the discussions as interactive as possible and as, I would say, interesting as possible. And we certainly have all the ingredients in the panel for doing so. We have Mr. Sanjeev Sharma, who is probably one of the most respected commissioners of income tax of the country, who has been donning the hat of the APA commissioner, and I'm sure he'll enlighten us with his views not only of the Indian government, but as all of you would be aware, before his stint as the APA commissioner, he was also part of the OECD. So I'm sure he'll also provide certain views of the OECD as well. We have Mr. Vishwanath Kini, the global tax head of a very renowned and respectable outbound company of India, Tech Mahindra, and we'll be privileged to have his views. We generally, we hear the views of the inbound economy in India, so here he is going to talk about his experience the company has faced while dealing with taxation issues, permanent establishment issues outside the country. And of course, we have a fellow partner and a very respectable professional, Mr. Rishi Kapadia. So welcome everyone on the stage. The way we have structured this particular panel is, I'll try to set the context of the issues in hand with respect to permanent establishment, profit attributions for a few minutes, maybe for the 15 or 20 minutes, and thereafter we'll have the panel discussion on certain set of questions. So with this, let's unfold the session as the session will begin. As all of you are aware, and we don't certainly need to speak on what permanent establishment is, but basically what happens is, and I think it's important to set the context first before we get into the deliberations. You see, when a foreign enterprise does business in a certain country, which is generally called the source country, in a manner that it participates significantly in the economy of that particular country, then you can say that the source country has a right to tax the profits of that particular country through a physical presence of the enterprise, which we call as the permanent establishment. Of course, there are exceptions like the source rule concept, particularly followed by the UN in the developing countries, where you do impose taxation of withholding tax on royalties and FTS, even when you don't have a physical presence. But those are exceptions. But otherwise, when you have a physical presence of a foreign enterprise, and when you exceed the threshold, you say that, okay, it's creating a permanent establishment, and you tax it. Important thing is that, look, every foreign enterprise don't avoid setting up of a subsidiary and wish to operate, let's say, by itself as a presence in a source country, not as a matter of tax avoidance, but sometimes they do as a matter of a business consideration. So, for instance, if a foreign country wishes to set up an agency instead of having a distributor, a subsidiary to carry out distribution functions, it's not because it's avoiding its tax in India. Maybe it's for commercial reasons. Maybe the customers want to deal directly with the foreign company. It needs to get project import benefits. Sometimes you don't want the foreign exchange fluctuation risk to sit in the system of the MNC. So there may be several reasons for which a foreign company may wish not to set up a subsidiary, but to carry on its business through itself, or maybe through an agency also. And they are perfectly all right from a commercial standpoint, and not for the avoidance of any PE or taxation. You see, there have been a significant amount of dispute as to what really tantamounts to the avoidance of permanent establishment. And as part of BEPS Action 7, which was introduced in 2015, and several rounds of papers have also been introduced thereafter, several of the loopholes which were there, which foreign enterprises were using in a manner not to create that presence. So, for instance, that commissionaire structure, which is generally prevalent in civil law countries, we have this artificial splitting up of contracts. We have the complementary, I would say, transactions where you have a PE for a small object, for a small purpose, and you are carrying out business in another model for another purpose. So, those splitting up of contracts, artificial avoidance of PEs, etc., were well addressed by BEPS Action 7. So we don't, and in India, from an Indian standpoint, because of our common law set of countries, because of our common law set of rules and not the civil law rules, many of those restrictions, many of those, I would say the open areas or the loopholes which were otherwise there in the OECD model were already taken care of. So in today's context, as we stand in 2019, I don't think the focus is not that much on whether there is the opportunity of avoidance of PE. It's more on, if you have a PE, then how much will you attribute? What will be the profit that will be attributed to the PE? I always feel as to the empty question which you generally ask as to, do you have a PE or you don't have a PE, is becoming an empty formality. So what is the use of fighting over a theoretical subject whether I have a PE or don't have a PE, when the important thing is, if I have a PE, how much of profit can I actually attribute? I think let that be the major issue, let that be the major question, rather than really fighting over as to whether I have a PE or not a PE. Of course, this is so far as the traditional business model is concerned. There would certainly be an exception so far as the digital business, so far as the digital space, and I'm sure all of us, you would have heard in the first session that you had on the digital PE, but we're going to have many more questions on digital PE, and let's not say that everything which the OECD is saying is sacrosanct. So there will be several questions which will come up on the OECD's, the paper which they've been released on the digital PE. We'll talk about that. But as of now, let's restrict ourselves to the issue, apart from the digital PE, as how much of profit can you really attribute to the PE in the various circumstances. So with that, we'll proceed with this particular discussion. One is on the conventional model, which is the brick and mortar model, which we have understood so far, having done business, having done transactions over the last several decades. That will be one part of the discussion. And the other part of the discussion will really be on the digital PE, which the OECD is bringing up as part of the consultation paper, public consultation paper. And so we're going to also spend some amount of time on that. Now coming to the conventional model of profit attribution to PE. As all of you would be aware, the OECD has brought out what we typically call the authorized approach for attribution of profits to PE in 2008, before the so-called amendment of 2010. Now, in the 2008 authorized approach to the PE, which was based on the earlier, I would say the model convention of the OECD, Article 7, which talked about a PE being hypothesized as a distinct and separate entity dealing with the rest of the enterprise, with the various parts of the enterprise in a manner as if it's a third party. So there was a deemed separate entity approach which was there in the OECD, by virtue of which you could have said that if the PE which is there in the host country, if it was a separate and distinct entity altogether dealing with the other parts of the enterprise, how would it have dealt with? So question is, was there an arm's length principle already enshrined in the existing, or I would say in the erstwhile 2010 model of the OECD convention? This is the first point. Then the OECD brought out the authorized approach in 2008, and thereafter an amendment was made in the 2010 version, where Article 7 to a certain extent was changed to bring into its existence that the profits to be attributed to the PE will just not necessarily be on the separate entity approach, but also having regard to the functional asset and risk analysis. If you read the commentary of the two commentaries rather, one was the pre-2010 and the other the post-2010, that means the authorized approach of 2008 and the authorized approach of 2010. And I'm getting into it because this is very relevant from the document, from the draft document which was released by the committee of the CBDT from the Indian standpoint, and we're going to come to it. So what the OECD said was that the principles of arm's length, the arm's length principles of transfer pricing, was very much enshrined in the 2008 model, and there was some ambiguity. If there was at all an ambiguity on the provisions of arm's length price, it was on the context of internal dealings between a PE and the headquarter. So what do you mean by dealing? So let's say if a PE, you can conceive it to be a branch, you can conceive it to be an insulation PE, etc. If that PE was, let's say, dealing with its head office in a manner that the head office was licensing some technology, some intangibles, providing some services to the PE, And if the PE were to pay or remit, let's say, a royalty or fees for technical service, would you get a deduction would you get an arm's length deduction in the hands of the PE, or will the deduction be restricted only to the cost involved in at the level of the head office? Now, in the pre-2010 model convention of the OECD, there was a little bit of a dilemma or a debate. There were some commentators who were of the view that no, the existing model of 2010 Article 7 already took into account this arm's length principles of dealing, whereas some commentators felt that no, it was not there, and you needed to have a separate amendment to actually bring into place this particular, I would say, the provision, as a result of which, when 2010 amendment was made, it was made very clear that even the dealings, internal dealings between the PE and the head office will be at arm's length. So I would say, from my standpoint, and we'll be having the privilege of hearing from Mr. Andrew Dawson of the OECD as to what the OECD's views would be, that at least what I feel, that the fundamental principle of the arm's length price of transfer pricing was very much there, even in the pre-2010 model, with the exception that the ambiguity that was there on the arm's length dealings was the one which was removed and specifically brought in. If it was otherwise implicit in the provisions of the OECD model, it was made explicit by this 2010 amendment. Now, having given this particular background, let us now delve into the very important document which was released by the CBDT, which was a draft document released by a committee which was formed by the CBDT in April 2019, which brought about a new concept which has been introduced by the CBDT, still at the draft stage, but is very clear as to in what way it's going to attain finality, because taxpayers would need to do their business, would need to model their business accordingly, because there is a point beyond which people cannot live in uncertainty. And we're going to ask these questions to Mr. Sharma and to everyone as to what the thought process would be. So before we move to the digital PE aspect, let's deal with the conventional model. And before going to Mr. Sharma, let me first ask Rishi and Vishwanath as to what is your views so far as the concept of attribution of profits to PE, which was there in the OECD, and which the Indian government is trying to take a different view in this regard, as to whether do you feel that even in the pre-2010 model, the arm's length principle was already enshrined therein, barring this particular aspect of the dealings between the PE and the head office. And by dealings, I'm talking about these payments of royalties, fees for technical services, etc., which could not have been, let's say, paid at arm's length. So for instance, under the UN model, there is a specific prohibition. There is still a specific prohibition that you cannot pay royalties or technical service fees beyond the cost. Some of the Indian tax treaties have a specific prohibition. Some of the tax treaties of India, which India has signed, do not contain any sort of prohibition. So in this context, what's your views on what the situation was pre-2010 and post-2010? So Rishi, if I may just start with you.
Thank you, Rahul. Yeah, hi. Well, I think the way if you look at the pre-OECD 2010 situation and post the amendment which has been made, I always thought that when you have a permanent establishment, the whole challenge is, of course, how to attribute a profit to a permanent establishment. And in arriving at the profit attribution, you need to treat it as a separate independent enterprise, as good as a subsidiary in an entity. And you would want to determine profit attribution. Now, even if we go back, forget what the OECD has done, the amendment, but even when we look at the Indian law, when we looked at business connection, even business connection used the concept of profit attributable to a business connection. So it was all linked to the business operations attributable to a business connection. In that context also, our courts were saying that you need to really look at profit is generated across the value chain. Some profit is attributable to the manufacturing function, some profit is attributable to the to where the sales are done. So in a way, what the courts were looking at is that you need to look at the functions and the actual extent of operations being carried out in a jurisdiction. So if that was the entire concept, I think arm's length basis was the only way of really determining the profit attributable to a PE. Now, looking at how the OECD dealt with it, I think the OECD also had the separate independent entity concept, and there were guidances which were issued. In all guidance, it felt that it was the profit attributable to a PE had to be determined based on arm's length basis. There was a slight distinction between the way OECD Article 7 was worded and the UN model was worded. But the distinction was more in connection with allowability of certain deductions. So if you look at a UN model convention has things like force of attraction rule, and in terms of dealing with a PE, it would say whether you could get a deduction, or rather it would say you would not get a deduction for interest payouts, royalty payouts. So therefore you look at a lot of Indian treaties which would restrict or are based on the UN model. A lot of Indian treaties do have a force of attraction rule. They do incorporate rules to restrict deductions for payments between a PE and the HO. But it still incorporated the separate independent entity approach, which is nothing but the arm's length. And I feel that the OECD, when they came up with the 2010 amendment, it did nothing but merely clarify what was the position earlier, and what was implicit has just been made more explicit. So at least I would look at it that yes, I don't think that there is a major difference between what was a position pre-2010 and post-2010, and the arm's length price should still be is an acceptable contact even in the pre and the post scenario. So,
Vishwanath, would you like to share your views and also the experience which you have faced, your company has faced in the other countries?
Yeah. So I think what I'll do is, I'll just give an example of what we faced in a country like Australia. The issue what we were facing is, the profits what we were actually attributable to a branch which was existing in Australia, that was anyway taxed. Now the question arose that if there were any services rendered from India, whether that is, and if it is effectively connected, whether it will also be forming part of the permanent establishment. And if yes, whether the entire amount has to be allocated to that particular permanent establishment, or it is only to the extent what is attributable. Now here, there was no discussions on the arm's length price. They have gone to an extent of deciding this matter against Tech Mahindra, which is now in public domain, that if there were any services, now generally what happens is, for a typical IT company, you have a composite contract where you render service from India and you render service in Australia. And there would be some type of services wherein it is not divisible. It is a composite one. And in that case, the courts held that once any of the services what you have rendered in India is effectively connected to the permanent establishment, then the entire revenue should be allocated to the permanent establishment in Australia. Now, this was something I don't think we have heard of internationally in any of this jurisdiction. I think I would like to also give one example, that in the course of the discussion, when the matter was being discussed at the courts, the judge did ask, how have the Indian courts held these type of services? Suppose if there was an Australian company doing business in India, how was that being decided by the Indian courts? Incidentally, the Ishikawa decision was in our favor, but I think whatever they decided, they ignored the Indian decision, and they have decided against us. Now, entire IT company is really facing this problem because of such type of decisions.
Thanks, Vishwanath. Now, I'll come to Mr. Sharma, and with a few questions, if I just put the questions in the context first before coming to your views.
Might be, Rahul, I will just respond to what is told about, Vishwanath has told about the case. See, we had similar case here. I don't think that you refer that case, because the AR decision was in case of Worley Parsons. And in that case, the similar type of situation arose, that if some services are provided or rendered from India, and some services are provided from Australia. This was Australia-India treaty only. Sir was there, Sunil Gupta sir was there that time. So the AR gave, because AR gave a decision that whatever services are provided or rendered from India, only that can be effectively connected. And what is provided from the Australia that cannot be considered effectively connected. So we discussed that what the Kloss-Vogel commentary says, what the interpretation of the term closely connected or the effectively connected have been. Effectively connected have been what comes out of it, what sprouts out of it. Based on that, I think it was a very good, of course, department had lost in that case because we could not get the connected to what was being done from Australia. But if you consider on personal basis or from the international tax point of view, that was good decision. If services are not rendered from India, not provided by the persons in India, that cannot be considered effectively connected. So now we need to see that a country which is a OECD member and such type of interpretation coming in, and we say that our courts are giving a very bad decision, wrong decision. We need to have introspection and see that how our decisions and our tax administration does for the cases than the other countries are doing. Thank you.
Thank you, Mr. Sharma. And before proceeding further, a warm welcome to Mr. Andrew Dawson, and we are really privileged to have you as part of the panel. I think without the presence of the OECD, any discussion on attribution of profits, whether to the conventional P or to the digital P, would be incomplete. Thank you, sir. So, Mr. Sharma, now coming to the next question, which was the fallout of the discussion, of the initial discussion that we had on the pre-2010 and post-2010 OECD model. Sir, in April 2019, when the committee of the CBDT brought out this discussion paper on the attribution of profits to the PE, the committee had suggested that the arm's length principle were not adequate enough to cater to the need of attribution of profits to the PE, and it proposed the adoption of a formulary approach based on a formula that to the starting point were the global profits of a particular enterprise to be prorated to the Indian sales, and certain weightages were to be applied, which was referred to as fractional apportionment. So it was formulary approach based upon fractional apportionment was something which the committee of the CBDT had suggested. It's been almost 6 months that the report was released. It has not been finalized. We're also not aware as to what the status of the report is. Now, so the questions which I have is that the grounds which were cited by the committee of the CBDT, I'm not saying the CBDT, I'm saying the committee of the CBDT, to discard the principles of arm's length price under transfer pricing, were 2 or 3. First, it was said, again as I mentioned that the first debate was, the Indian model tax treaties are based upon the UN model and the pre-2010 OECD model, which as per the government did not contain the principles of arm's length price. It only came into being in the 2010 or post-2010 amended OECD model. That was the first reason. The second reason that was pointed out by the CBDT was that the arm's length principle did not actually do justice or was not equipped enough to attribute proper profits to the market jurisdiction, which as per the CBDT, as per the committee of the CBDT, the only way to have a proper solution for attributing profits to the market jurisdiction was through a formulary approach and not the arm's length principles. And thereafter, the committee went to suggest the formulary approach in the manner that we said. So I know, sir, you represent the government, and here, if you would just, do the balancing act of giving your personal views, not obviously too much in contradiction to the government views, and come up to say that, do you really believe that the arm's length principles are not robust enough or are adequate enough to justify attribution of profits to the market jurisdiction?
Thank you, Rahul, for this beautiful question. See, if we look into the arm's length principle, if the transactions are between associated enterprises or with the enterprise, then in that case we know that Article 9 of the tax treaty applies. This Article 7 is different from Article 9, and this deals with the taxation of the business income of the permanent establishment. So we need to make a distinction that the same arm's length principle will not apply for Article 7 as far as the position of India is concerned. OECD authorized approach that was accepted in 2010 commentary, but certainly we do not follow the OECD commentary as such. We have our own tax treaties and we just implement that treaty. Keeping this in mind, if we look into that, what the government wanted to do by coming out with this position, this was because looking, if you see the background of the case, there were many court cases, then there was a lot of uncertainty and all. And at the same time, what is happening in the global world, that what the significant economic presence we had, then the concept of what is happening in the taxation of the digital economy, keeping that all those factors in view, the government came out with some sort of, I should say, a position for the stakeholders to respond to it. The industry to respond to it, stakeholders to respond to it, looking to the practical aspects that whether this will be workable or not. If not workable, what should be the correct thing? So it is good always to put up something, because if you just rely on Rule 10, and Rule 10 was being the way it was interpreted by different court differently. Somebody says 15% of the profit can be attributed, somebody says 35% can be attributed. Then we have the court decisions. Keeping all those in view, we thought, okay, what the FAR constitutes of, okay, if it is sales is one of the important factor, then the assets is important factor, employees are important factor, and in case of digital economy, whether because user is also important factor in case of digital economy. So keeping all these points in view, that in April 19, this paper was put up for the comments of the stakeholders and all. Those comments are there, and as I can understand that certainly it is to discuss it more, to have more and more whatever is happening on this front, and because we are also really be part of the inclusive framework, similar type of things are happening at the global level. We need to respect that our participation and our voice over there, and keeping in mind, I think government may come out with the final solution as of now, and may wait for some time. So I have nothing more to say on that. Thank you.
So I'll just add one or two more questions on this, and of course, when we come to the aspect of the digital PE and the profit allocation, we're going to have more insights from Andrew. But for the time being, if I just may restrict the question from the perspective of the document released by the committee of the CBDT. So if I may just take a very simple example, very, very simple example. Let's say a foreign company has a branch in India. I mean, I can also conceive of a agency PE, but let's not make it complicated. Let's have a very simple example, has a branch in India. And the branch carries out trading functions. That means the branch imports finished products from the foreign head office, and it sells in India under a distribution model. And let us say one does an absolute first, top class FAR analysis, comes to the conclusion there are no unique marketing intangibles which are being contributed by the branch in India. It carries out routine distribution functions. And based upon a proper study of arm's and economic analysis which is carried out, let's say it is agreed that a 3% return on sales is an adequate arm's length reward which the subsidiary will need to have. Sorry, I'm rephrasing the question. Let's say the foreign company is a subsidiary, not a branch. This will be my second part of the question. The foreign company is a subsidiary in India, carries on distribution functions, no marketing intangible, nothing around that. Simple, plain vanilla distribution, 3% return on sales, agreed to be the arm's length reward or the price. Now, instead of that subsidiary, let's just flip the structure to say, now instead of a subsidiary, the foreign enterprise has a branch in India carrying out the same function. No change in functions, no change in risk analysis, nothing around that. So in that case, why would not that same 3% return on sales be said to be attributable to the profit which the branch would be making in India? And why would I need to attribute global profits of the foreign enterprise, which may have a cutting edge technology, very highly sophisticated technology, very strong trademark, etc., where the global profits could be in the vicinity of 20%. So why should I need to have the global profits prorated to India for being attributed to the branch, while the same 3% return on sales cannot be applied? I mean, I think a question which even the audience here may also like to ask as to why wouldn't the same arm's length principle be applied for the branch, where the branch and the subsidiary are carrying out exactly the same function?
No, it's also a very good question. The issue is that, see, it's a group decides that whether the business need to be done through an enterprise or through a branch. This form of doing business depends on what level of activities and what type of business, how big the business is in the country. If the functions performed, assets used and risks assumed are identical, then the result should be similar. Okay, but keeping this in view, now let us look into how it is looked into. If a branch is there, then certainly the profit and loss account will be drawn. If the profit and loss account is drawn, only the issue is that what will be the treatment of the transactions which the branch is having, which is head office or the affiliated entities. If those transactions are at arm's length, if that is at arm's length, then certainly there should not be any issue that the results should not be the same. So in case of associated enterprise, the transactions, because we say that this enterprise is different from the another enterprise, we consider two entities, so we can measure the arm's length nature of the transaction by applying the transfer pricing law. In case of when it is a branch, then this is a part of the foreign entity. This is not a separate enterprise as far as the domestic law is concerned. In that case, then the issue of applicability of Article 7 comes into play. Then what expenses can be allowed as deduction, what expenses cannot be allowed as deduction, that comes into play. So we need to respect the Article 7 also, along with Article 9 if it is the associated enterprise. So only the deduction allowability will be the issue, and as far as the profit is concerned, that I think should be the similar.
So we only hope that good sense prevails. If the CBDT at all would need to finalize.
Tax administration always does with the good sense, and we just say that pay the fair amount of tax in this country, and the tax administration is always positive.
Sure, thank you very much, sir. Before we move to the digital, yeah, sure, Rishi.
So I completely agree with the last statement that you made, that the entire approach that you've taken is trying to simplify taxes and trying to simplify this whole issue of profit attribution that we're dealing with. But you know, providing or even making an attempt to come with a formula is commendable. Yes, it's out of the box. You're thinking something differently from what others are. But I just have a few things that, you know, even if you want to ultimately come to a formula approach, that formula has to be somewhere more consistent or more, it can't be so consistent, and at the same time it has to also factor into the, you know, business nuances, because every business has I know it's not possible for doing it for each and every business, but there has to be some linkage to the type of business that is being. So I'll give you an example. There are so many cases you'll have where there are contributions to intangibles. Now, the attribution formula really doesn't factor into anything towards intangibles, towards you know, trade intangibles, marketing intangibles. So your asset, which is to be worked out, will never factor into such marketing intangibles. So let's take an example that you actually have a patent. Now that patent will have its own shelf life, say for 5 years, 10 years, as it may be. Now that patent, when you really, at the time of exploitation, and you'll have the Indian entity do the sales, marketing, etc. At that time, it doesn't really incur that much expenses towards your towards marketing efforts, towards creating some marketing intangibles. But at the same time, it would probably get a higher profit allocation based on a global operating profit margin, on technology aspects, on the patent aspects, which are probably all sitting outside. So to that extent, there is a higher profit attribution that you're doing to the PE out here in India. Now let's move on at the end of when, you know, once the patent expires. After the expiry of the patent, you'll start incurring more you know, expenditure towards promoting the product, and you'll in fact create more of marketing intangibles. Now at that point of time, you'll not have any profit being attributed to that intangible. So I think to that extent, you know, while the formula is good, but that formula doesn't really balance it over the business reality. So I think there needs to be some balance. Again, for example, you might see even ITITS, if you take a global operating profit margin, that global operating profit margin can be very high, Whereas in India, most of the entities work on a cost plus model. And we've kind of agreed on what the cost plus can be. So in that scenario, again, going back to a global operating profit margin would amount to a high profit attribution. Again, if you look at the employee base, an employee base for ITITS entity out here might be really huge compared to globally, but the cost may not be. So I'm not too sure whether the formula really factors into more business reality. So I feel that it's good to come up with a formula which simplifies life for everybody, but that formula should kind of take into account more business realities, and a more refinement of that would really help.
No, Rishi, I think before that, I think let's be very clear. The need to go to a formula, I think, will arise if there is a consensus, if everyone feels, that the stakeholders feel that the arm's length principles are not adequate enough to attribute profits. Let's be very clear. And I think the audience would also need to understand, everyone need to understand, that by arm's length principles, if one feels that only a TNMM or a cost plus or an RPM, resale price, is all about arm's length, that's not arm's length. Depending upon the scenario, and again I'm saying depending upon the scenario, if you feel that the market-facing entity is contributing to marketing intangibles. Let's take an example. If you feel that they are contributing to marketing intangibles, no one prevents you to apply a residual profit split method. And mind you, residual profit split method is also arm's length principle. It's also transfer pricing. So point is, and I personally feel, and maybe it's a larger debate. It's a far, far larger debate. And I'm going to raise this question to Andrew as well when we talk about the digital PE. That you cannot have transfer pricing in the books to say this is transfer pricing, this is arm's length principle, have all the methods, including other method, including residual profit method, and say it is not adequate enough to allocate profits to PE. If it is adequate enough to attribute profits to a parent subsidiary, where again the contract, just having a legal contract is not sacrosanct. There is no sanctity just of a legal contract. In the case of a parent subsidiary, one can always tinker, one can always write whatever they feel like in the contract. It's a conduct, it's a question of how these people are behaving with each other, how they are actually conducting with each other. That is the more important thing. So I feel that either you have transfer pricing or you don't have transfer pricing. And you move to a completely formulary approach, you move to a completely thumb rule, you apply formulas, etc. to come to it. So I personally feel at some stage, stakeholders across the world would need to understand either transfer pricing should remain, or you have the confidence to do so, that, okay, you have the confidence in the system. There may be a little bit of a subjectivity, but that's the whole fun of having the method to the madness, rather than saying, no, it's not good enough. So let's move to a formulary approach. So, sir, now coming to the digital P, and probably we'll start with Andrew. We have had this public consultation paper, which was released by the OECD last week on Pillar 1, several sub-variants of that, amount A, amount B, amount C, and we're going to come to it, sir. So to start with, when we talk about the scope for digital taxation, I personally feel the OECD has to come out very clearly as to what they want to tax as, or what they want to subject as digital tax, what sort of industry they want to subject to tax. Because you see, in today's highly digitized world, there hardly any company which will not do business through the enablement of technology. So for instance, the hotel that we are currently staying in, that we're currently using for the conference, tomorrow if someone wants to book a room in, let's say, Oberoi, Udaipur, it did not speak to any representative. It can go to the website, it can see all the catalogs, it can just see all the features of the hotel in Udaipur and see the rates and book it online. Would you call it a digitized business? Or would you call it a digitally enabled business and not a digitally technology-driven business? So how would you actually define, where would you draw the boundary between a technology-driven business and a technology-enabled business for applying the digital taxation module? Would you please elucidate on that?
Okay, thank you. Good afternoon, everyone. So, excuse me. While I give myself a moment to collect my thoughts on scope, I mean, maybe I could just kind of preface those remarks with just something on the AOA and the pre-AOA, which you were talking about earlier, just to sort of give the, if you like, the OECD position on that. And we talked about, does the pre-AOA 2010 approach, is that an arm's length approach, or is that in the way that the post-AOA is? And the answer is yes. I mean, there was always this concept of a distinct and separate enterprise, and we've changed the words to separate and independent enterprise, if I've got those the right way around. But fundamentally, there was always a fiction going on in Article 7 that you needed to attribute profits to that permanent establishment, and the permanent establishment is a place. It's definition going back years and years, and the Article 5 and Article 7 fit together. So you've got a fixed place of business through which the business of the enterprise is wholly or partly carried on. That's your Article 5. Then Article 7 tells you to attribute the profit on an arm's length basis as if it was a distinct and separate enterprise. Now, it's true that there were some restrictions in how far you could push that fiction, and I heard you mention the United Nations model, for example, which has an explicit provision in Article 7 of the UN model that says that there are certain things that you can't have a deduction for. Now, that's not so terribly different from the OECD approach, because although the OECD doesn't have that extra language, partly because it's not free from technical defects, but it doesn't have that extra language because it was not thought necessary, because the commentary explains that there's a limit to how far you can push this fiction. And what happened with the AOA is we had a more perfect realization of that fiction of a separate and independent enterprise, where you would have more, dealings would be more fully recognized than they were before. But you always had, a deduction for, you always got cost of goods sold in the accounts of the permanent establishment. So it's possible to exaggerate the differences between the old and the new, and I would certainly want to underline that the old was an attempt to realize an arm's length approach. Now, if I can, try to pick up your question on scope, and how do you, I suppose, kind of delineate what might be digital. But the feature of the unified approach is that we're not trying to ring fence the digital economy, and that was something that came out of the Action 1 final report. It's not possible to ring fence the digital economy, so that's not what we're doing. But we're in scope. We've trying to develop, and this is just an OECD Secretariat proposal. I should emphasise that it's not something that that anyone has signed up to. We're sort of seeking consensus, trying to move things forward, as Grace Perez-Navarro was explaining this morning, and hopefully people will sort of kind of come on board. But as they do so, no doubt there will be sort of changes along the way. But we're not trying to ring fence the digital economy, but we've got this concept of a consumer-facing business. Now, and the proposal on scope is that if you've got a consumer-facing business, which would not be cutting down trees, or would not be mining for coal, or mining copper, or whatever it might be, if you've got a consumer-facing business and it's sufficiently large, and there are various sort of ideas about how large would large be to come within scope, then the presumption is that group would be doing things which would interface with the consumer in a way that would itself establish a nexus. Now, there may be some other factors as well, because countries have been pretty clear for the most part that we're not trying to capture mere selling, but there's got to be some sort of positive engagement with the market jurisdiction, which is kind of where we came in with the idea of the digital economy, if I can put it that way, or users. And this was a feature of one of the three proposals that was mentioned in the program of work, an idea that you would somehow recognize the value that users are creating, and you would sort of somehow attribute that that value that the user's creating to the enterprise in that jurisdiction. So there would always have to be something kind of going on there. And what we're doing now is we're having a new nexus test, which is not tied to physical presence, and we've heard that mentioned a few times this morning. Sorry, that was probably sort of terribly unthought through and roundabout, but well, for now.
Okay. So let me now add to the question, and of course, though it'll be initially directed to you, but I'll request Mr. Sharma, Rishi, and Vishwanath to also step in as they may deem necessary. So we all agree that in today's context, when the economy is so very digitized, and you can do business, a foreign enterprise can do business in a source country without a physical presence, with with social network sites, with websites, etc. And this is the classical, the word that you use, scale without mask. That means you don't need to have workforce, you don't need to have sales force, you don't need to have people to procure data, etc. You can all do through these social network sites and the websites, etc. So while we agree that probably a digital presence, a digital PE may be the need of the hour, maybe the need of the times, a few questions which arise. Number one, as part of the unified approach, the OECD has said that even if a foreign enterprise does have a physical presence through a subsidiary, even then, if it is otherwise falling within the scope or the boundary of digital tax, which I'm sure the OECD will be prudent enough to define, it will still have a digital PE. That means in spite of the returns which the distributor might be earning in that particular country, whatever the arm's length return would be, that is, again, I'm just using a little bit of a technical jargons, those would be the amounts B and C of Pillar 1, which are the arm's length price that you're talking about. Beyond that, whatever the digital PE is going to have, that will be subjected to a formulary approach based upon percentages. So, you take the entire profits of the group, you give a routine return, again, based upon a fixed percentage to be prescribed. The residual profit, then you're saying that will be allocated by, again, applying a fixed percentage to say this is relating to marketing functions. And then again, that will be subject to a further apportionment with reference to sales to say, okay, this is a profit relatable to the marketing functions in this particular jurisdiction. So we are applying a formulary approach mandatorily for all digital PEs so far as amount A is concerned. Now, in this background, let's ask a few questions to ourselves. What does digital PE stand for? It is no doubt a proxy. It's a proxy for physical presence. Physical presence for what? For two sides of the supply chain. The right-hand side is a supply side of the supply chain. The left-hand side is a procurement side of the supply chain. Because of the digital presence, you can do the marketing, you can do sales, you can also procure data without physical presence. Now, if that be the case, and if that is clearly the case, then the question arises, what would you attribute as intangible to the digital PE so as to subject to a formulary approach and not an arm's length principle? Generally, there are two sorts of intangibles which you can conceive of. One is the trade intangible created by R&Ds, and the other is a marketing intangible which you create through marketing, distribution, creation of dealer networks, sales representative, etc., etc. It is very clear, and I think it is beyond even any contrary conception. The OECD is also very clear on this, that they do not want to attribute trade intangibles to the digital PE. Then it's only the marketing intangible. If it is a marketing intangible, then my first question, is not the residual profit split method adequate enough or robust enough to attribute profits to that particular digital PE, where you're only allocating marketing intangible or not trade intangible? So what is the need, do you feel, again, to discard arm's length principles and go into this concept of formulary approach under amount A? So once you give your answer, I'll be grateful if Mr. Sharma, Vishwanath, and Rishi would also provide your answers. Okay,
thank you. Well, I don't quarrel with your characterization of amount A. I think your description of the arithmetic, I think, is right. But thank you. But we're not using the concept of a digital PE. That's not how amount A works. In a way, you could kind of start. No, let me talk about amount A, because it's a purely formulaic approach. And you're right, it's done on the group basis, which is another reason why the concept of PE doesn't really work for a group. So you take the whole group's first of all revenue to see whether they're in scope and they meet the other scope tests, and then you ask yourself whether they have a nexus with the market jurisdiction. And the first test of nexus, and I mean, who knows, it might be the only test of nexus. The first test of nexus is, are there sufficient sales in that market jurisdiction? So, we're miles away from any kind of notion of a PE, let alone a digital PE, or any kind of formulary apportionment. We're taking group profits, and then we're saying how much of those are routine, discard them. I now have residual profits or non-routine profits. We say we're going to give, if you like, if that's the right word, attribute some portion of those residual profits to the market jurisdiction. Now, conceptually, you can think, okay, that's for those certain activities that happen, but that's not a feature of the calculation. It is purely a formula. So you then have some amount of profits that are available for allocation among market jurisdictions, and then you do so based on some agreed allocation key, which could well be sales. So it's not transfer pricing, it's not the arm's length principle, it's something completely different. But then amounts B and C are the arm's length approach. Amount B is some sort of fixed, agreed amount that allows businesses to have certainty that if they're only performing certain prescribed marketing and distribution activities, then they will pay amount B, and that will be the end of the matter. If things go beyond that, if the company in the market jurisdiction is carrying on, is doing more than that, then the market jurisdiction can argue for amount C. Now, that brings you to the question, what's the sort of link between amount A and amount C, given that amount A is conceptually designed to reward some of the things which you might think amount C is doing. And we're aware of these questions. They're difficult questions, and it's something that we're working through over the next weeks and months.
Mr. Sharma?
Thank you, Andrew. See, what is, as of now, the Secretariat paper which has come in is a unified approach, keeping the three bases which were provided earlier, the user, marketing intangible, and the SEP. Different countries had different perception or different proposals. Secretariat had just come because they need to move forward, so we need to appreciate that something is for everyone to comment. Now, industry will have, whether they will be able to have such type of implementation will be practically, it will be possible. For the stakeholders, for the industry, for the people, academia, professionals, the tax administration, everyone will come out with, even there will be countries' positions on all these things. If you look into my personal, based on whatever my experience I am having, the implementing the law, it's really, really very, very difficult. Whatever is A has been provided, that A will be the non-residual profit will be allocated. Okay, so first thing will be what will be the non-residual profit in a particular country for the particular business, for the particular industry, for the division and all, is always who is going to decide that. And then, so if it is the whole is to be allocated by some basis, but Ranjan sir said in the morning that it's not only that for the, because of the, for the users or for the, it has to be whole profit. what is the significant economic presence thing is this approach, unified approach, is fraught with lot of practical implementation problem. It's good. I think that industry will. So this is the, if I say that my reaction on personal basis, but certainly whatever has been put up, as I said, this need to be appreciated. Someone need to start from somewhere, and that beginning has been made by putting this paper. Let everyone come out with whatever the best solution is possible, and I think we should look for the best solution. Maybe not by end 2020, what is the mandate, but it is a beginning. Let us see when it can come. So this is my comment.
Vishwanath and Rishi, would you just add your views?
Yeah, I think I'll look at from the angle of any such type of service or digital service happening in any other country for us. Now, it's very difficult to really identify whether the entire value for the use of digital was in a particular country. So in such a case, probably the global revenue could be one model in which you can think of an allocation. And whether, suppose if, let me give an example, if it has been significantly used in the country like Japan, probably a significant portion of revenue or allocation should happen in the country of Japan, and the others should get a different share. So that's my simplistic view, probably. I don't know.
So, yeah, I think the unified approach, which is it's just been released a few weeks back, and it's a starting point to kind of determine how you're really going to get about taxing, more and more digital businesses. But at least there is some consensus to say that yes, the new nexus rule that we're looking at would not really be based on a physical presence. Yes, the computation is today at a very conceptual level where you're talking about amount A, amount B, and C. And is based on formulary approaches. This will have its own implications and challenges. Identifying what is the scope of the digital business that we seek to cover within the formula is something which one will really need to clearly lay down in the paper. There's still a lot of work to be done around that, and how do you really determine the proportion of profit that you would want to attribute to each of the market jurisdictions will itself have its own challenges. And maybe the way while the whole idea or the approach is to make it more simple, we need to also be sure that how do we really have our dispute resolution mechanisms. So if there are no adequate dispute resolution mechanism and each country really follows its own rules, then the entire approach could get lost. And there is equally a need that while we work towards creating a unified approach, there needs to be a unified approach on dealing with the tax disputes that could arise in relation to the attribution amongst the market jurisdictions and other jurisdictions, and how speedily can that be resolved. I think that's very, very critical in arriving at this entire consensus.
I think Rishi, that was very well said, because at the end of the day, the whole idea of BEPS is to have a convergence and not to have a dispute everywhere. So either we have a convergence in terms of the proper approaches to be adopted by various countries. Arm's length principle, again, as we said, you can say it's a method to the madness, but there is a method at the end of the day. So either that's adopted across the countries, or countries move towards more of this thumb rule like Brazil has. I mean, Brazil has safe harbors. So one is another approach, moving to safe harbor in all countries to solve dispute. But resolving dispute is very, very critical in today's world. I think we could have gone on, but I think we'll be conscious and respectful of Mr. Sharma's time, because I think he has to catch a flight, and we also started a little late. So probably we need to, I would say, draw curtains on this discussion now, or we could have at least have 2 or 3 more questions. But Mr. Sharma, if I may have your permission, can we ask, or are you constrained by time?
Please continue. I may move by time if I can get my flight.
No, please. So I think we have to draw curtains out here. We started a little late, and if I may just throw the floor open to some questions from the floor, if you'd like to ask. You won't get a better set of panelists that you're going to have on the stage. And the lady wants to ask a question.
Good afternoon. This question is to Sharma sir. Sir, the formula which we have come out in our April paper, is that based on some testing of data which we have done, because we already have 15 years TP papers, TP data with us. We have now in last 5 years, lot of MAP have got concluded. We have over 300 APAs signed. So the confidence, I'm sure, when we are saying that FAR, whether we do as branch or as P or subsidiary, if FAR is same, the result is same. So have we done some kind of testing, some kind of data population actually before coming out with these formulas? Or how, department has arrived at these formulas or these numbers?
I'm really not sure of that, whether we had done that research based on the data, because this formula is for the attribution of profit to the permanent establishment. And what I am of the view means based on my practical experiences, that most of these permanent establishments are construction projects, permanent establishments, and that is very few. In fact, really we have very, very few permanent establishments on which such type of data will be there. So I'm not sure that whether based on that, but certainly we have come out with a paper, and because if the information is available, because taxpayers also on anonymous basis, they can say, okay, that this is the suppose such type of information, and this is giving a very distorted result. This is not a practical result. In fact, that is the thing we wanted, the administration wanted, that please come out with, because it was open for the stakeholders. Even if it is closed, you can still come out with, if you have any information, you can provide to the tax administration. Yeah, thank you very much.
Thank you.
This is to Mr. Dawson. While we talk about this digitized world and largely transactions which happen in the digitized format, is the OECD also factoring the risk of leakage and evasion through the possibility of cryptocurrency being used? Some of the countries have legitimized bitcoins and cryptocurrencies. Some of the countries have banned it. Some of the countries are grappling with it. But going forward, when you create a nexus and you start taxing these entities, don't you see a risk of transactions happening through the net, through the internet, through cryptocurrency, which is completely out of the system? And do you factor that in yourself?
I guess that's a separate question. I mean, and it doesn't form any part of the work on the unified approach. We haven't sort of thought separately about that. I mean, to the extent that it's a problem now. And it's, as I say, there may be things that we could and should be doing to address that concern, but they don't form part of this work now.
So my question is to NTU again. So what we are saying is that if I continue to follow traditional approach and I have a branch in the source state and I end up having a P, then we are saying we are okay with arm's length. But if I add little bit of digital element in that and I sell the same product, say through my website, then we are saying that we are going to formulary approach. So what I'm trying to say is that do you see any contradiction between the two approaches? Just because I have added little bit of technology, as Rahul sir is saying that it's digitally enabled and not a digitally driven business.
Okay, I wasn't quite sure who that was to. Yeah, I inferred that it was probably for me. Well, I mean, there are different views about what one could and should do. When Grace Perez-Navarro was talking this morning, she mentioned that there is a group of countries who would make no change whatsoever. And I suppose those would be countries that would assent to your analysis, that just because you've added a bit of digital, why does that mean if I've understood what you're saying, that it would change. But I mean, the proposal is what it is. It recognises that through the digital engagement, there is an engagement with the market jurisdiction that goes beyond mere selling. For example, because there are users in that market jurisdiction, or in the case of maybe a pure seller into that jurisdiction. If the volume of sales are so high, it betokens some sort of interaction with the consumers in that market that warrants some allocation of taxing rights to the market. Now, I guess whatever kind of model you come up with, it's possible to say, oh, but that's not fair. Haven't you thought about this? And any kind of change is vulnerable to criticism about exactly where you draw the dividing line. But there we are.
My question is to Mr. Masa. Even Rahul can also step in, because till now we have learned about the levy of tax on real income. Now with this percentage allocation and all that, are we slowly and gradually drifting away from taxation of real income to notional income? Maybe I'm just in the context of even India is coming with lots of fair valuation coming up. So are we just giving a go-by to the well-established one of the canons of taxation to tax the real income? And with a certain percentage being allocated and all that, are we slowly and gradually drifting away from this principle, sir? Your thought, please.
No, certainly not. See, if the income arises in a particular territory, if the income is because of that particular territory, because of the operations carried out in that territory, only that income can be taxed. And this is because this really is very difficult to find out that what is the income which is coming out from that territory. So it will always remain the real income, but how to measure that income, how to find out, I think that is we are trying to find out those rules that a certainty is there for that, for both for the tax administration as well as for the taxpayer. We are just trying to find the answer for the real problem we have. Thank you.
Thank you, sir. Thank you very much.